We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mark Magarian, Senior Portfolio Manager at Pine Valley Investments, where he manages a value fund focused on hard assets and cash flows. Thanks for joining me today, Mark. How are you?
Very well, thank you. Thank you for having me.
Of course, it's great to have you back, and it's been just over a year since we chatted last. So thought it would be kind of a good time to get you back on the show. Talk a little bit about what has changed in the last year, how your views have changed, maybe your positioning, or how you're thinking about things. So maybe we could kind of start from a higher view and really what's driving the markets right now. Of course, we've had this big run up in rates, and I think we really have yet to see the full culmination of what that run up in interest rates will do to the economy, how it materializes. So how are you seeing, let's say, the yield curve inversion and how that kind of sets up this time in history?
Right. I definitely think that since we last spoke, we have, the economic cycle has moved on down the line towards the end of certainly this cycle. And it looks like the Fed hiking cycle is probably at a close. And so certain things are certainly coming into view. So, yield curve inversion, I think, is probably what I'm most laser focused on at the moment as it starts to un-invert. So, the good thing about a yield curve inversion is it has 100% track record of un-inverting eventually. And when it un-inverts, there's a very, very good track record of, precious metals performing very, very well thereafter, mainly because the un-inversion is caused usually by the Fed choking at the front end and or combination of the back end blowing out because of inflation. So you're already starting to see hints of that now. And the yield curve has remained uninverted, and it's was quite steeply inverted, at levels not seen since late 70s sort of levels, for some time. And we know that this doesn't last forever. It's not tenable. The market's telling you something. Mm-hmm. And the lagged effects of monetary policy, as you just alluded to, are certainly still yet to be seen, whether that's in commercial real estate, small business, bank lending seizing up, all of which are occurring. We obviously, since we last spoke, we had a mini crisis in sort of small regional banks, which the Fed was able to cover up with a emergency facility to essentially liquefy their losing treasury assets. And be great if we could all liquefy our debt instantaneously, on different assets we own and just get liquefied. But they get special treatment. So, the writing certainly is on the wall. You can see it coming, and, the data is starting to slow. Even the inflation data, which, came out today, is still moderating down to sort of the threes annualized level. And, that is still extremely lagged too, because one of the biggest components of it, which is housing related, that is not showing at all what's going on now. I mean, house prices have absolutely collapsed in many areas of the country. The housing market's gone completely stale. Rents have come down too. And I'm seeing that real time in businesses I'm involved with and I see. So it's definitely happening. And that's not even in the data yet. And that's probably still going to start to seep in over the next 6 months. So as that happens, this sets up to me at where we are right now, an asymmetric bet on gold, where, you have probably something like 5% down, maybe up to 50% up. Certainly 20 to 30% you could see quite easily. And, what some of the mining companies might do relative to that kind of move should be, multiples of that. So, it's a really, really compelling moment right now, where you've had a really good correction in the mining sector relative to gold, really going over the last few years. So it's been pretty dead, but that's the perfect situation for this to occur. Mm-hmm. If you look at, gold mining performance in the sort of the mid-early 2000s, the performance was terrific as gold rallied from historic lows, and, they were coming from a position of being very cheap. So performance was good. But if you look at gold miner performance in the last part, sort of between sort of '07 to 2011, wasn't that great because the valuations were already getting quite high. And so it wasn't the same risk reward. And I'm talking broadly, obviously, there's always those individual stories that maybe outperform or underperform that statement. But where we are now, certainly for me, is, that opportunity is what I most focus on right now versus maybe last time we spoke, energy was more the forefront and this was sort of simmering in the background.
So maybe just to make it a bit more explicit, Mark, what is the signal, let's say, that is the best for gold right now? Is it when that yield curve un-inverts and the Fed really kind of comes to that realization, or how do you see the explicit signal there?
Yeah, I think I will give you a three-pronged answer, okay? Is the twos, tens, going into positive territory from being inverted to uninverted. I think the dollar making decisive lows, breaking down from weekly and monthly lows. And then the third prong would be seeing tips, starting to outperform short-term yields. That's another popular indicator, essentially, of real rates. And when you see all those three things happening, you should see gold start to act well. And the setup right now, as it sort of continues to coil, a gigantic cup and handle underneath 2000, the technical setup's there too, if that counts for something. Decisive breakthrough 2000 and closing there on a monthly basis, combined with the three things I just said, should be, the green light for a, certainly a, maybe a 6 to 9 month move. And then we'll see what happens there. I think the further out you go, the more cloudy the crystal ball gets. And, although I could have a 5-year view that's still very optimistic on gold, if you use, 2007, 8 as an analogy, if things get that bad, which they may, in whatever ensuing economic, crisis may or may not occur next year, you could have that situation where gold in that example ran up from $700 to $1,000 and then collapsed all the way back with Lehman. And then it was a good buy thereafter. So you can have lots of ups and downs on this road to wherever we end up here. In the short to medium term, the setup is here and, the data's starting to agree. And as the Fed starts to choke going into Q1 next year, as we likely start to see them pull back on any rate hike rhetoric and more, start to talk more about, when's the first cut, then that should see, these indicators perform. And hence, you should see gold, making new highs. That's a high confidence expectation at this moment.
Do you think when we actually see that yield curve inversion, that is in some ways just a catalyst for, or a signal, maybe, clarify which one you think we could kind of apply there, a catalyst and or a signal to really have some kind of financial catastrophe that precipitates in the Fed really changing course? Is that kind of how you see that?
Yeah, I mean, I think it's well documented that yield curve inversions tend to predict recessions pretty accurately for good reason. Essentially indicates that the Fed has over-tightened. And the longer it stays there, the more issues that creates with the capital structure of business from small to large, all over the spectrum, really. And so, that's already obviously flashing a big signal for some time now. And it's coming out of that position is usually marked with a recession and then the Fed doing something about it, i.e. choking and cutting rates. And that then uninverts the yield curve and you see what happens next, right? And, it's hard to say how bad we'll get. I mean, it really is very, very difficult. But again, it's also hard to say what the Fed response will be. They're talking tough now. They may respond much more aggressively than we could imagine. That central banks usually do. And what's that old saying, that the market stops panicking when the central banks do. So, if things get bad enough, I'm sure that their response will be as nuts as their last one. And, well, once again, that kind of all roads point in that example to being in hard assets as a good protection and certainly something that you'll see people go to. And, that's another factor as well. You talked about the position of gold miners to gold right now. But what about gold in general? I mean, the West, the interest is, minuscule. So there is very little speculative froth in the futures market. There's very, very little interest in, if you look at it on some of these physical gold ETFs, they're not taking on a bunch of tonnage like they used to, although that looks like it's stabilized just recently. So that might be an early positive indicator, actually.
Mhm.
When the Western institutions come to the party on this, Katie barred the door, because there isn't the same supply available.
Mhm.
Since the East and, other countries, BRICS have hoovered so much gold up over the years, it creates a much more inelastic upside move if they come in quickly and wanting to get that allocation back in their portfolio. So
Mhm.
we'll see if that comes to pass. But there's only so much gold going up and treasuries going down and the stock market probably going flat or down that these guys can take before they want to join the party.
And of course, that's something we've talked about many times on the show, is the idea of, that rebalance of assets and what that rebalancing really does to a sector that is much, much, much smaller than the rest of the equity sector. And what kind of an opportunity that really, as you said, the asymmetric bet that really presents for gold and the miners in that case, right?
Right, absolutely. And to mention one stock that I do not own, just disclaimer alert, but Newmont Mining, for instance, is like the only S&P 500 gold stock, I believe. And, that thing is just an absolute dumpster fire, right? It's making new lows only a few days ago, even with the index bottoming out already. And, there's some specific things going on with that. But the point being is that would be the easiest place for there to be some inflows, kind of the S&P 500 tracker folks to maybe overweight that if they like gold. And clearly they are not. There is no interest whatsoever there. So, yeah, interest is at a low. So, as a contrarian indicator, kind of like it. I prefer to be early than late. So,
I mean, that's a really kind of an interesting point that we were kind of talking about before we record here today, is the idea that we have been early for a long, long time. So how do you conceptualize that when we have this divergence between the technical indicators and the fundamental indicators? And how do you really avoid getting killed when the fundamental view is that, let's take the dollar, for example, that the dollar should have failed a decade ago, but yet the Fed and the central banks have kept the party going for this long. So how do you kind of square those two circles?
Right. I think it's very, very important to come to grips with this statement. It's more important to win than to be right. And many, many very smart people much smarter than myself, talk great macro stories, and they talk about it on podcasts, on interviews, and they say that, basically the same thing, for as long as I can remember. And I remember making my biggest mistakes when I was the same, where I was so tied into a view and the need to be right about it that I would ignore any other factors. And I could be very passionate about it. And everything I was saying sounds so logical to the right person. They'd be like, well, what he's saying must be right. Yes, but guess what? Timing. Everything always takes longer than expected. It always does in everything. You have to understand that, especially if you're managing people's money and you're a steward of people's capital, that it's more important to win than to be right. You have to come to grips with the fact that just because you have an idea does not mean it's going to come to pass in a timely manner or at all in some cases. And so the way I approach things is I kind of have a macro view, and I do. And, in all our interviews, I've obviously had some strong supply demand with a hint of macro thrown in views on different commodities mainly, right?
Mm-hmm.
But the way you win within the context of that is understanding where you are in the cycle. And when you're picking what vehicles you invest in to expose yourself to it, whether it be the physical or individual companies, what edge do you have? Are you purchasing something at a discount to intrinsic value that will give you that support to win, even if you're wrong on timing? And that is, in essence, my entire strategy and what I do. And it's very, very important, and it's hard. You have to find situations where, so let's say, we're bullish on gold, but gold stocks don't look that great. The cycle doesn't look like it's that favorable, even if you have this great view on it. Well, what about, is there a company out there that's trading at a sufficient discount for reasons that are overblown with a much more optimistic outlook coming in the future, that you can look 18 months out and say, this is going to look way better and would look like an absurd multiple if I bought it today, even if gold did not move? just as one kind of mini case study there.
Again, kind of going back to that idea of finding a type of asymmetric bet, even if the underlying asset doesn't necessarily have to move, right?
Right, that's it. And when you find those, if you've done your homework correctly and you have bought something below intrinsic and its own internal catalysts play out and you didn't overpay for them, then even if gold hasn't really moved, there's a good chance that worst case scenario, maybe you just haven't lost, which will still put you ahead of the rest of the pack, as so many things can go wrong in a flat or negative gold or silver environment with some of these companies. They're serial diluters. They make bad acquisitions. It happens all the time. And so things can go wrong while you're waiting, and they can go wrong badly. So you need to really, really make sure that you're doing the homework there. And I really try and make myself agnostic to my kind of macro view in those situations. Now, then you get the double whammy though, because now if the macro view comes true and you've got one of these, well, now you're really positioned, if you're right, to significantly outperform. You've kind of got the double whammy going on. And that is what served me well. And I've applied that to every sector I look at, even outside of commodities. And, like anything, nothing's 100% perfect, but, you only have to be right a good amount of the time, and it covers you behind nicely.
So let's dig into the actual application of that a little bit more, if we could, Mark.
Sure, absolutely.
The idea don't get killed while being in the markets here, of course, is really important. So are there particular types of assets or companies that you're focused on that are either cash generating, dividend generating? What is it that you're kind of offsetting this timing with to be able to keep that exposure positive for yourself?
Right. I mean, in the end, I always start with as I said, an accurate view of intrinsic value and then what discount to that is. So how I start looking at that is quite simply is what is my free cash flow expectation at a neutral price expectation of whatever the commodity is, let's say 12 to 18 months out. And then model onto that what the cash burn, let's say, looks like getting to that, or positive cash flow possibly as well. I'm really trying to understand the chances of a dilution. What does the debt look like in terms of the balance sheet? And is there any exposure there? How can it get to that goal without blowing me up along the way? And then even when I found all that, does the multiple that I'm paying for that look like a discount, or does it look just fair? Has the market already priced it in? And often the market does not value that if the numbers don't look good. And often that might be the case if there's been some sort of one-time item. Maybe there's been a big project which is being built, which is messing with the free cash flow. Like you need certain things possibly disguising that story. Like it's not so disguised that somehow you have to be an insider to know it, but it may require a second level thinking and a little bit more investigation to craft that number in the future. And honestly, the more disguised it is, the more likely that it is hidden, because a significant amount of the market is algorithmic. And it chases certain features of balance sheet changes, whether it be debt going down, free cash flow going up, free cash flow growth quarter year over year. A lot of momentum chasing algorithms out there. You see it all the time. So when the numbers don't say that, but that it will look like that, and you feel very confident that it will, then that's the beginning of a good setup. And I've applied that to all the different sectors I've looked at. It's gold, silver, oil, gas, uranium, you name it. It doesn't really matter. But you do still need to understand roughly where you are in the broad cycle within that. But you don't have to get it exactly right, which is the thing. If you make too bold a macro call with the wrong stocks, it could be terminal.
Well, of course. And that's why I wanted to kind of dig into that a little bit more. So you mentioned gold, silver stocks, you mentioned oil and gas and uranium. So can you give us a sense of, let's say, what portion of your portfolio kind of splits into those particular pieces?
Yeah, it's funny because the first couple of times we spoke, the first interview I think I did a few years ago, I told you I was massively into energy, right? Mm-hmm. And that was ridiculous prices, 40% free cash flow yields, things that if you look back on it in hindsight, you don't even believe it existed, but it did. And that was amazing setup. Then the last time we spoke, we're about halfway through that on energy. Gold was starting to look more interesting as it started to cool off, and it cooled off. In fact, that was a low back then, but the miners haven't really done anything since, even if gold's picked up from 1700 to where it is now, right? And uranium was probably the area, nat gas as well, were the two areas that I was most excited about. Today, the makeup has changed. Uranium is more mature in its bull market now. I still own it, like it. It's going to go higher. Yeah, I mean, uranium's going to $100, no problem. But it's in the stage where now everyone's piling in. And so you have to be more cautious about that. Adding new money here, I'm a little bit more conservative in that regard. I don't like chasing things. I like buying stuff when everyone doesn't like it and then selling it when everyone does. So, while I do like it, it's that's a little bit less. My energy exposure is quite a lot less, although I do still have a large nat gas position, essentially, via a company. And that still looks really, really great over the next few years. But, even that's not the same value as it was. I mean, it's still good value, like it, still happy to hold, but it's not an asymmetric bet. I wouldn't use that terminology, where it's just so lined up. It's still a good one, but it's not like, wow, this is like a 10-to-1 risk reward with a 70 or 80% chance of success. Like it's, a kind of, you'd roll that wheel and as many times as you could afford, right? And so the greatest part of my portfolio for sure right now is gold and silver to the tune of maybe 60%.
Or the one that you're most excited about?
Out of gold and silver specifically?
No, out of your portfolio in general, because you said you've lost some of the potential energy, let's call it, for the uranium trade. However, you see more potential energy right now for gold and silver.
Yes, absolutely. Yeah. And how that plays out, I mean, gold, I think, is clearer now, but I suspect silver runs with it. But I think that for people who are looking for like the big silver move, silver squeeze or whatnot, I've commented on it in the past, that's still out there as a possibility, but I suspect that might be kind of the cycle after this cycle, meaning that gold possibly outperforms now as we run into some economic issues, but silver tends to perform better with a more of an inflationary setup, which might happen thereafter, after the Fed's reaction to whatever happens next. So that could be 2025, 2026, where silver goes to 50 or 100 or something fun like that, which is possible. I mean, it could do it. But yeah, I mean, certainly the precious metals are my top area at the moment. And gold in particular, I think, is probably the best setup. Very, very good risk reward. And as I said, if you're exposed to assets that are likely to perform well, even if you're not quite as correct as I think I might be, then I should still win a little bit, enough to keep the lights on.
Well, of course, being agnostic about the timing and buying the right asset, I think, is a much better way to approach this market rather than being reliant on this macro view playing out over the next, let's say, 6 to 8 months kind of thing. But I wanted to get your take on really this massive divergence we've seen between the price of gold and the value of the miners. Like, what explanation do you have for that major spread that we've seen really build between those two, in some ways, asset classes?
Right. And what I'll talk about now is very nuanced. Okay. There's not a set number for what something should be in what I'm about to say. But some part of it is simply that gold essentially is the same price it was a few years ago. It's gone flat and costs have gone up. So margins have gone down. So, the miners of a few years ago, when gold first had its big move after COVID, margins were really fat. And now a lot of them aren't even making any money at this price. Mm-hmm. And so costs have crept up. And that is a big part of what you just asked. However, there are other factors too. How much embedded optionality is there in these stocks for potential large upside moves in gold? Well, the answer is there's very little priced in for that, which is good. That's where the opportunity is, because in many cases, your stocks you're buying, like perpetual call options, essentially, where you're getting that real option level, leverage to the upside, right? But without the same level of decay. But inside that one other level, there have been so many missteps by so many different gold companies in the last 18 months that just weighs heavy in the end on everything. I mean, there have been so many dilutions, cost overruns, ridiculous takeovers, everything from Newmont's takeover, right? Or, I Am Gold, spent over $3 billion on a mine that they're only supposed to cost them $1 billion. Like, how did that happen? And there's many, many examples. I don't own any of those, but there are so many missteps, and that doesn't look good. And a lot of people have been burnt. And a lot of, I can think of, without naming any more names, but there are other really popular retail plays that have just been, eviscerated, just destroyed. Where now what you're left with is a company that's so crummy. Like, how much does gold and silver have to go up for you to get back to where you bought it? Which comes back to our previous conversation about you've got to buy right. You've got to buy good assets discount, right? Otherwise, you may still lose if your macro view is wrong. So that's part of why there's a discount. But therein lies the opportunity also, because in amongst the rubble, there are still opportunities. And I still think, broadly speaking, even if you just go broad or like through an index or through Barrick or something, somewhat safe, or Agnico, something without a bunch of hair, but isn't necessarily trading at like a huge discount or anything, I'd say that, you're still getting a very, very good price if you think that even a fraction of what is perhaps being suggested is going to happen to the gold price in the next year, where we could be looking at like 2,500 gold or maybe more. Those guys are going to perform just great. And your downside here is relatively low in high quality names, that's for sure.
So how do you kind of go about gaining that informational advantage, let's call it, on trying to find these assets that you're interested in riding out this storm in?
Right. So I have a process for that. So for starters, and of course, I only have so many eyes and only so many people helping me. There's always going to be things you miss, but usually start with finding a stock that's being beaten up, and then go and look at the balance sheet. And I look at the cash flows, and at that point, maybe it will tell me two things. It will tell me, my God, look at all this cash flow. Why is it trading so cheap? In which case, now I need to answer that question, right? And that's usually because the cash flow is about to run out, or there's some other level of hate or fear surrounding the assets involved or something. And then I need to go and assess that, right? Or it has none and it looks terrible, in which case now I go and find out, well, when's that going to stop? And so first thing I do is I go to the website, look at the presentations, and a good presentation from a company will tell me a lot. Like, I like a company who freaking spells it out. If they're dancing around it too much, it doesn't sound good. I want them to tell me, hey, this is what we're going to do. This is what we're going to expect. And this is how much free cash flow we think we're going to make. It's like, okay, well, now I can hold you to that and at least see if you can pull it off. And then I always speak to management. I ask them tough questions. I want to find out what their plan is. I'm like, well, what is your plan once this free cash flow emerges? Are you going to go buy something else? Are you going to spend all the money? Are you going to pay down debt or whatever it may be? But I need to understand that these people aren't going to just take a win and immediately turn around and go off on another wild goose chase or do something which is going to, again, depress the stock multiple, right? So I need to get really confident in the management and develop a pro forma that there are enough catalysts that point in the future, like I said, 12 to 18 months out, where the numbers they will generate at that point, if I then reverse engineer them to today, that I'm buying at a multiple that sounds ridiculous. That's what I want. And when I say ridiculous, I'm wanting like 25 to maybe even 50% free cash flow yields. I want really, really crazy stuff. If it doesn't sound crazy, it's probably not a discount. Okay. So I want it to sound good. And most people always say, well, it's too good to be true. It's like, yeah, well, that's because it doesn't look like it and everyone hates it and you haven't done the work. And it's my job and part of my process to establish if the setup is truly that, or am I wrong about something? Is the market right about it? And I have a lot of questions that I ask of myself and of management, a lot of boxes to tick to tell me if this is that kind of setup. And usually happens with smaller stocks, but it can also happen to bigger ones too, where there's enough missteps and the numbers look bad enough for long enough that it gets beaten up and starts to act poorly. And there's a few even happening right now. So that's essentially the process I go through. And then once I've established that and I accumulate a position, and I take large positions, relative to the portfolio size, I get up to 10, 20%. I regularly own 1-2% of a company. I own 5% of a company which just got acquired last week, actually. A few days ago, rather. So don't mind getting in and not quite getting on the board or anything, but I definitely make my opinions known of what needs to be done. So when it's hidden enough and I feel good about what it's going to look like, well, then I have to obviously judge management's performance to that expectation, right? And then when things, let's say, go right, then great, it's performing as expected. But when it maybe doesn't go as expected, then you're kind of in a penalty box situation where it's like, okay, tell me why it didn't work out. Is it still going to work out? And then, fool me once, fool me twice. Once you get to the third time of being fooled, then you probably need to get out. It's because they're not executing. They're just making stuff up and telling you. And there have been times like that too. I remember 3 CEOs ago on I Am Gold. So you can reverse engineer who that was. Some years ago, 5-6 years ago, that guy was one of those. Tell you one thing, not deliver. Tell you a new thing, not deliver. Just never ending. Eventually you got to go, well, none of what you're saying and my models are wrong because it's never going to happen. And that was a good call because that's not been a great investment.
As you're talking about the idea of generating free cash flow, does that mean you're only interested in actually producing assets? Or is it possible that you see, let's say, a Greenfield project or even a brownfield project that you're very bullish on because of, let's say, some informational advantage that you had?
Well, the advantage is funny, right? Because it's not so much about having any knowledge, obviously, the market doesn't have. It's more a case of how widely is accepted is it in the price of what the future might look like, right? And with enough hate surrounding a sector or a stock, that information can be unpriced in. And the way you do that is by making that model. Now, with a situation where you don't have free cash flow, it's easier for me to go, hey, the market knows this company's building this mine. And if you believe what they say, they're going to make $100 million in free cash flow in 18 months, but the stock's trading like it's going to make zero. That knowledge is potentially very, very interesting. And as long as they execute it, I'm probably stealing it, right? With an explore company, a Greenfield situation, it's harder, right? Because you don't really have a point where you're going to get real free cash flow. So I've had stocks like that in gold and silver and in uranium. And I have invested there. It's not as big as when I have cash flow, because these stocks historically, when things are bad, they can trade very depressed prices. And typically they also have to dilute for capital, which is another unfortunate component of being in those companies. So I typically use significantly larger discount ratios. So for instance, if a company is got a resource and they think that it's going to cost this and make that in the future, what I'll do is I'll go, okay, so it's going to cost you this much, create an enterprise value, put on what it thinks it's going to produce, and discount that back massively to today, big time, 80% discount, really big discounts. And then look at what that looks like. And then maybe that gives me a bit more comfort. But yeah, that's a little bit more nuanced and difficult. But that's how I try and look at it. It's not a massive part of my portfolio. Because you see, free cash flow, always bails you out. See, I look at businesses like I look at real world businesses, as I also buy real world businesses, is in the end, you need the cash to hit your bank account. That's going to save you every time. And if an asset's not going to do that, you're left just paying the taxes and stumping up money for it to grow. And then eventually you may have to sell price you don't want. So I'm a bit more cautious in those situations, although there are obviously some great stories out there. I know, definitely missed a few of those. It's not for the faint-hearted, that's for sure. It's harder to get, I think, an information edge on those. Mm-hmm. Because usually the only time they move is when there's some great drill results or something, in which case that's pretty out there. It's not particularly hidden. And they're not building, so there's no catalyst, let's say, in the future, unless you think they're going to sell. And that you don't ever know, right? That's always something you can never know for sure. So those situations don't typically present the type of setup that I like the most, unless the commodity associated with it is dumpstered so much, so bad, that now these things are trading at fractions of NAV. Some uranium explore companies were trading like that in 2020, for instance, right? Next Gen Energy, for instance, right? That traded down to 60 cents. Mm-hmm. Now it's $6. And, that's pretty much the most robust uranium project out there. But that doesn't necessarily have a path to production. But back then, that was a really big enough discount to take that risk. And there are other things, say, just in that example, that kind of give you more comfort. So, for instance, the zip code's correct. They're in the biggest producing area in Canada, right? They're literally next to Cameco. Cameco has to acquire them at some point, for instance, to stay relevant in the area. That thing can't go into production without them. There's almost no way it can happen. So there's some things about that particular situation that make one more comfortable with it. But there is a lot of exploration companies in the gold and silver space, and not many of them end up working out that great, even though during a bull run, they often perform well. Mm-hmm. But can be a bit of a crapshoot. And I don't pretend to be an expert at geology to be able to separate these things out properly. But I like to think that I know what I'm doing with cash flow and how management deploys it.
So do you have like let's say a particular rule that you try to keep if you're interested in one of those positions, that you keep it as a particular percentage of your portfolio? Or is it when you feel that you have some conviction in that play, recognizing that undervaluation by the market, and then make that move and kind of frame it with a particular time frame to be able to decide whether you were right or wrong in that position?
Right. In the end, everything comes down to having a good idea of intrinsic value, right? And if I feel the discount is big enough, then buying something cheap enough usually fixes all problems, right? So, the times where that happens is usually where you have hate on hate. So you have like sector hate with the cycle, broad-based hate in stocks in general, and then you've got some company which is just getting thrown out the door because it needs capital and da-da-da-da-da, right? And so if the pain is big enough, then usually the price is going to be interesting enough for me to be willing to take that risk that in 18 to 24 months, it could be at least double or triple. And I typically only like to buy things if I think there's certainly a triple inside of a few years as a really not unreasonable probability, but with a very high probability of a double. That's kind of my general rule of thumb. And there's a lot of guessing when you're trying to estimate if you think you have a discount, what that appropriate valuation will look like. And that's obviously not taking into account any news which happens along the way, and but good or bad. So you can get lucky and unlucky on that and act accordingly depending on what happens. But yeah, there's not one rule that fits all, but you definitely want to feel that you're buying something where there's enough reason to think that you're buying it from someone who's scared, and that there's enough upside over a certain amount of time that makes you feel comfortable to take any short-term volatility that may occur, because usually you don't buy the low. Usually it goes lower. That's a general rule of being a value investor, right? That's kind of the fun bit, is developing the conviction to really, really stand in front of it and just go, you know what, I'll take as much as you got.
I still like it even at these levels.
Yeah.
Well, Mark, I really appreciate you walking us through how you think about all of these things and how you think about your positioning. Is there anything else on your mind as of late that you think would be useful to our listeners?
Well, I certainly think I've touched on this idea that it's important to separate a very, very strong high conviction macro view and all the people who chant it with actual results and how you're going to get there, and not letting the two kind of interfere with each other, because they are more separate than you think. But in terms of, I guess, other areas that we haven't really touched on that much, I am still a bull on energy. And I think we're in a long cycle on that. We've gone from a position on energy where it was so hated, and now it's becoming more fashionable again, right? And even though valuations aren't crazy high or anything, they're not, but they're not like insane cheap like before either. Oil, for instance, I think last time we spoke, there was some supply setups going on there where there was a possibility that you could see kind of a spike up, and you haven't really had it. I mean, you had a little bit, but not that much. And in fact, now the way it's acting, given what's going on in the Middle East and that supply seemingly is still somewhat constrained, and they're trying to refill the SPR in small doses, albeit, oil doesn't seem to be going anywhere. Maybe it has a rally here as the Fed chokes and the dollar goes down. You probably see that, but it's performing like there's a demand problem, which ties into economic weakness, right? Mm-hmm. There might be some reason to have some caution there in the short term, but if you gave me a 2 to 3 year view, give me some time here. $120 oil? Yeah, I think so. I think that's coming. Mm-hmm. But the question is when and what discount can you buy anything associated with that? So it's not just purely a macro call. Nat gas, I'm more optimistic on, because there's a significant amount of export capacity coming online in nat gas in 2025. And current production levels, there is not enough production to cover it if there's any kind of colder conditions. So you could see my forecast is certainly 2025 is on the table, but by 2026, if you start to get some cold snaps, the odds that the strip in nat gas repositions itself to 5 and above, kind of like it did in the 2000s nat gas cycle, where it was down in the 3s, and it ended up going to 10 and staying between 7 and 10 until 2011, pretty much, right? It stayed there for a long time. Those nat gas companies made a fortune. And if you model that on some of the nat gas companies today, you start to get to those silly numbers, like the 50% free cash flow yields and that kind of thing. And so to me, there's still a very good opportunity there. And I don't have to be 100% right about nat gas doing something nuts, as long as it just stays relatively firm, which you could make a very strong argument for that. You know, a lot of the companies are still very well run and have good cash flow yields. So the nat gas story, I'm probably a little bit more, no pun intended, warming up to. And I'm still there. And 2025 is kind of what I'm looking at for that, maybe to kind of bear significant fruit, although it has been extremely successful thus far. You know, the investments there have tripled pretty much, and the nat gas price is really, you know, has really done a round trip, right, in the last 2 years. So good example of actually, you know, if you're interested in nat gas, don't bloody buy nat gas. Like it's not a good investment vehicle. Buy a company that is at a discount to it, that has its own hedging program that essentially smooths out that volatility. And now you might actually make some money out of it. And I've seen that happen to a lot of people. That's a mistake. You know, you've got to find a way to express that view in a manner that allows you to win versus being right. Coming back to that. So yeah, those are still my main themes right now. Believe it or not, I have a little hopper of names in the broad market, including everything from Disney to Target, things which we don't typically talk about on this sorts of podcasts, that, you know, look like they're starting to get hated, but not quite hated enough. But there's a cycle there as well, where a lot of these companies are coming from crazy prices and a lot of missteps and other things going on internally. And I expect that by the time this cycle's done, there'll be plenty of opportunities in areas that might not be as familiar to us. But I don't want to miss them. So I'm keeping an eye on it and wondering if one day I'll look at them and it'll sound like I'm describing a great gold stock in terms of cash flow yields. And I'm like, oh, this might actually be a good idea. But I definitely won't do it unless I'm interested. And I'm sure at the time everyone will hate it. Yeah. So, you know, maybe that'll show up sometime. But that's maybe a few more moves on the 4D chessboard ahead than where we are today.
Mm-hmm. Well, I appreciate that. Really, that agnostic view on any income producing company and not just kind of pigeonholing yourself into one particular area.
Yeah. I mean, you've got to be like that. And honestly, if you ask me what my biggest mistake was in the last 18 months, it's not buying Facebook. And I'll tell you why, because if you go back and look, it was hated, it was dumpstered, it was gapping lower, everyone hated it. It got down to 10 times free cash flow, which is not maybe the kind of free cash flow levels that I like for like some commodity companies, but for essentially a borderline monopoly tech company, that's actually extremely low, right? I have a lot of negative bias surrounding certain things around that company, and that affected me at my decision. So I'm put my hand up and say, you know what, probably should have bought that one, and it tripled. So I mean, that was a miss, you know. And I focus on that. I don't want to just talk about the winners. I think about what I could have done better, and staying agnostic to situations and being to come out your box. I probably need to do that better, but. In that case, my excuse for not doing it was they announced all this capex, which sounded completely bonkers, on their like metaverse, and the only thing they had to show for it was that thing which looked like a Wii video game, you know, like if you're doing Wii tennis or whatnot, and it was like $50 billion a year for that. There's no way anyone's going to do this. So anyway, I couldn't do it. Woulda, coulda, shoulda. Maybe next time.
But I think that's an interesting lesson to be able to take from that situation, right? Is the idea that despite your negative bias, and I think I would be right there with you, having a negative bias against buying that particular company, seeing its performance really kind of changes your view, and hopefully you learn the right lesson from that, right?
Absolutely. And I've touched other things out of our sector successfully before, but it's still something I'm trying to get better at. But thankfully, at the moment, all that stuff is crazy expensive. Don't even touch it with a barge pole. And obviously, the opportunity lies in the yield curve and un-inversion play, which is firmly centered around gold. I am absolutely convinced that I am not missing a trick on buying NVIDIA or anything like that. I don't care about AI stuff. Most of it's complete crap. You know, it's like that. Have you seen that meme of Will Ferrell from Zoolander where he's like, I feel like I'm taking crazy pills? It's like that when they reveal something and they say it's AI, and isn't just this like an algorithm of someone answering basic questions when you're trying to like get in for your phone bill? This is what they're already doing. And then when I actually go and use a real AI, chat, GPT or whatever, I remember I signed up for it for a month and I tried asking it anything useful in my world and either gave wrong answers or I had no idea. So I think that's a little bit overdone at the moment. I'm sure it'll change the world one day, but no, I think it's a little early, like it usually is, right? A lot of these tech fads are like 10 or 20 years before their time. But certainly some of the multiples on some of these tech stocks for anyone who mentions it, it doesn't seem to justify it to me. And we've seen, as with last year, for instance, that when the floor comes out in this sector, unlike when you're playing a good value situation, the downside is big. It'll drop 70, 80% fast. And you don't necessarily have the conviction that it's going to come back. Sometimes it does, and many did this time, but not all of them have. And sometimes they don't. So in the end, cash flow is king. And that's what a good value investor thinks like. That gives you that base, that downside. And I'm certainly more comfortable in that. But yeah, I want to try and be open if any of that stuff ever hits my rules, but it doesn't look like anytime soon. We'll see.
Yeah. Well, I think those are two great pieces of advice there is cash flow is king and really trying to, I think those are really two lessons from Warren Buffett is also trying to buy when the rest of the market hates a particular entity and trying to recognize that, I think is something that we all need to get better at.
Absolutely. It's very hard. No one's saying it's easy. And that's probably why I like becoming so much more fundamentally focused versus technical and macro in the value space, in particular in commodities, because unless you have that really accurate assessment of intrinsic value with that cash flow horizon that is durable and is realized at some point, the downside is very, very high. But if you really have that bit right, you can have the conviction to not only get big, but to not get shaken out. And it's been the source of my biggest winners. It's been when that has been the case, when people are really, really panicking and they have just overblown the numbers and they're not really listening to what management's saying. And, you know, you've got to get that confidence. You know, when things are going down, people always find a reason to not believe it. And you've got to train your brain to maybe not think like that if you have that conviction and you have the right information in front of you for what the future may hold. If you do that right, then usually there's an opportunity and you live long enough to realize it.
Excellent, Mark. Well, I appreciate you expanding on your thoughts around all of these things with us. Is there anything you'd like to leave our listeners with before we wrap up today?
Oh, I think I've talked everyone's ears off enough on well, how I think the world should be. But good luck out there. I think what I said last time was, you know, avoid using leverage. It's always a good, like, you know, most of the bad things that happen is when you're over-levered. Find a good money manager or financial advisor who can help you maybe express some of the ideas, if they're similar to my own, in a manner that's going to help you make some good money and not find you in a bad position by betting the house when you shouldn't.
Perfect. Of course, you're available on Twitter at Maggers, Maggers 78, where you post some stuff that entertains you and you learn from, right?
That's right. Yeah, that's where I am. But you can find me on LinkedIn, I think is probably more business related. I mean, I do occasionally post some things which are related to some of the investment topics, but I also post all my political views on there and all that as well. So yeah, if you need to find me to ask questions about anything to do with business, you know, I'm on LinkedIn and you can find me there quite easily.
Perfect. Excellent. Thanks so much for your time today, Mark.
All right. Thank you, sir.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.